Now I'm going to take one practical question. I'm going to take the same question that I took at the time of equation and journal entries. So let me remind you, first of all, you have to identify the transaction, whether it's cash transaction or non-cash transaction. If it's a cash transaction, that will go to cash book. If it's a non-cash transaction, it might go to purchases book, purchases returns book, sales returns book, BR book, BP book, or journal proper. In journal proper, we simply make journal entry. And how to make journal entry? You know it very well. You have already done so many questions. So let's take the practical question. The same question. A starts business with cash rupees 5,000. A purchased goods rupees 1,000. Sold goods costing rupees 1,000 for rupees 2,000. These are the three transactions during the year in a firm. So if you notice at the first transaction, cash has come in, so this is cash transaction. Then purchased goods on cash basis, this is the cash transaction. Then number 3, goods were sold on cash basis, these are the cash sales, again cash transaction. So all these three transactions are cash transactions. You know, all cash transactions are recorded or noted down in the cash book. Let's make cash book. In the T form, it's just like the cash count. On debit side, we have to write down receipts, and on credit side, we have to write down payments. So number 1, A starts business with cash rupees 5,000 because it's a receipt for the firm. So this 5,000 will be written on the receipt side. I mean to say on left hand side in the amount column. So what will be the narration? To capital, because we have got the receipt and this receipt is for capital. Then purchased goods rupees 1,000. This is the payment and payment is shown on the credit side. So rupees 1,000, date 2, and the narration will be by purchases because this payment has been made for purchases. Then sales rupees 2,000. We have received the cash. This is the cash receipt. Come on the receipt side and write down rupees 2,000 and date column 3. What should be the narration? To sales. I have already told you cash book is just like cash count that you have prepared in the previous segments. So total on debit side rupees 7,000 and by balance CD rupees 6,000 as on 31st March 2013. By balance CD means by closing balance, because cash book will be closed on the day of closing and the closing is 31st March 2013. So in this way we have prepared cash book. There is no noting down in purchases book, purchase returns book, sales returns book, BR book, BP book and journal proper. So one thing more I would like to explain you here, the difference between accounting and accountancy. As I explained you the accounting cycle, the transactions are noted down in subsidiary books, then you have to do the casting of subsidiary books. Casting means making totals, then ledger posting, then trial balance, then final accounts. So accountancy is in different stages. You have to do the accounting activities in different stages, but the first stage is that transactions are recorded, means noted down in the subsidiary books. Subsidiary books are sometimes called journal. Simply single word, journal. Recording in the journal means recording in the subsidiary books. So up to recording in the journal or subsidiary books is called accounting, but the whole process is called accountancy. So you can say the accounting is the part of accountancy, or you can say accounting is the first stage of accountancy. if accountancy is divided into different stages, first stage is called accounting. Accounting means noting down of the transactions in subsidiary books. So I have noted down all the transaction in cash book, but there was no purchase book or sales book because there was no need to prepare all these things. So I have completed accounting. As we completed cash book, and the cash book was, there were 2 items on debit side and 1 item was on credit side, and by balance CD was on credit side. You will find that balance CD is always on the credit side. I mean to say the debit side will be always stronger than credit side. So this cash book is just like cash count that you prepared in our last segments. Now we have to start ledger posting on the basis of subsidiary books. I told you the steps: transaction, then recording in the subsidiary books, then casting of the subsidiary books. Casting means totals. Here the total means the totals of purchases book, purchases returns book, sales returns book, BR book, BP book. But these subsidiary books are not available in this question, so there is no question of casting. I mean to say making totals. So we have to start ledger posting now. So concentrate on the cash book. Let's see how many accounts are involved in the cash book. On debit side, one is capital account, then sales count. So you open the ledgers for capital and sales count. How to draw the lines, how to make the format of ledgers, you know it very well. You have already learnt in our ledger posting chapter. And on credit side, you find only one account, that is purchases. So write down purchases account. So 3 accounts are involved, and we have found these accounts through our cash book. So come to the capital account first. On cash book, this is 5,000. In cash book, the capital account is showing 5,000 on debit side. And this debit amount will be taken to the credit side of capital account. If there is amount on the debit side of cash book, what it means? Cash account has been debited. It means capital account has been credited. So capital account will be credited by rupees 5,000 in the ledger posting. To credit the capital account means to write down the amount on the credit side of capital account, that is rupees 5,000. So you can say this just like it's a seizure style. Debit item will go to the credit side and credit item will go to the debit side. Now on debit side, to sales count. So come to the sales count. If cash count has been debited by rupees 2,000, it is due to sales. It means sales account has been credited. So on credit side, you will write down 2,000, and in the narration, by cash, because you have taken from the cash book. You can write down by cash book or you can write down by cash count, whatever you like or whatever your class teacher suggests you. Nothing to do with the total of 7,000. Now come on the credit side. Buy purchases 1,000. It means cash count has been credited by rupees 1,000. So purchases account has been debited by rupees 1,000. So come on the debit side of purchases account, rupees 1,000. Again, we are applying the principle of scissors. You know, there are two blades of scissors. So left item go to the right side, right item go to the left side. So you will write down 1,000 on the debit column and 2 cash count, and the date will be 2 because there is no date, so we'll have to write down the serial number of the transaction. So 2 cash book or 2 cash count, whatever you like. So in this way, we have completed the ledger posting. You learned this ledger posting on the basis of journal entries in our previous chapters. Now, we are learning ledger posting on the basis of subsidiary books. You know, when the ledger posting is done on the basis of cash book, we have to apply the principle of scissors. So let us find out the balancing figure of each and every account. Capital account, on the debit side, to balance CD rupees 5,000 so that the totals on both sides can be made equal of rupees 5,000. This is the balancing figure on debit side. You know the meaning of balancing figure and to balance CD. Now come to the sales count. On debit side, to balance CD rupees 2,000. Total on both sides rupees 2,000. Now purchase account. On credit side, buy balance CD rupees 1,000. Even you can write down buy closing balance, but I am writing buy balance CD rupees 1,000. Total on both sides rupees 1,000. So all ledgers are prepared. Be careful. We have made cash book. Cash book and cash count is one and the same thing.